and welcome to our webinar, Building the CEE Region, Strategic Outlook on the Construction and Metals Industry. Thank you all for taking the time and join us today. We're excited to share strategic insights into two of the region's most dynamic industries. Our goal is to help you better understand the current market risk and economic trends shaping the construction and metals industries across Central and Eastern Europe. My name is Verena Schwarz. I'm responsible for corporate communications in our region at Coface, and I will be your host today. Let me briefly introduce today's speaker. First, we have Mateusz Staptai, our regional economist. Mateusz will walk us through the key economic trends impacting these sectors. Welcome, Mateusz, and thank you for being here.
Hello, everyone. Thanks for joining us.
Next, I'd like to welcome Marcin Sieber. He's our Regional Director for Underwriting Enhanced Information. Marcin will focus on the Polish market and highlight the major developments in construction and metals in this big economy. Great to have you with us today, Marcin.
Good morning and good afternoon to everybody.
And finally, a warm welcome to Bogdan Nikishoiu, our Regional Head of Enhanced Information. Bogdan is also an expert, of course, on the Romanian market, and he will share valuable insights into these local developments that are influencing these industries. Thank you for joining us, Bogdan, and hello.
Hello everyone, and thank you for joining us.
Before we get started, just a quick note on how you can interact with us during the session. You see a control panel on the upper right corner of your screen. There is a section for questions. Feel free to type in your questions at any time during the presentation. We will collect all of them and address them during the Q&A session at the end. Also, in the upcoming days, you will receive a follow-up emails with the presentation slides and the recording of the webinar. But now, let's get started. I'll hand over to Mateusz, and I wish you an insightful session. Mateusz?
Thank you, Verena. All right, so yes, let's start with a brief, let's say, a background or the macroeconomic context of the region. So yes, the economic growth has been mostly impressive, especially if you're from Croatia, Serbia, Poland, Bulgaria. Those are the countries that have seen the fastest growth rates since the pre-COVID times. So on the left-hand chart, you can see the cumulative growth rates since directly before the pandemic. So basically, all of the countries have rebounded since then. Albeit some of them has seen a faster growth rates than the others. And those are, as I mentioned, Croatia, Serbia, Poland, Bulgaria. But on the other hand side, on the other spectrum of the growth, we can see that there are some countries, perhaps that are much more integrated to, for example, German supply chain, which, as we all know, is struggling especially in the industrial sector. And so those are, for example, Austria, Czechia, Hungary, and Slovakia. So Slovakia and Hungary are actually a location of a lot of the foreign direct investments in the automotive sector. So, for example, for Slovakia, automotives represents around 25% of the exports, actually. But even for those countries that have seen a rather fast growth, the economic growth was not really driven by the industrial and construction sector, right? So on the right-hand chart, we can see the increase in value added of industry and construction sector in the Central and Eastern Europe. And as we can see, it's much more subdued, right? Not subdued for some of the countries, but even a recession, in a recession for others. Especially for those that, as I said, are much integrated into the Eurozone industry, right? So yes, we see Austria, Czechia, Hungary, even Romania and Slovakia. All of those countries are seeing actually levels below before the pandemic levels. And yeah, also, so as we already have seen a bit in the previous chart, the construction output, looking into a bit more detail, is also seeing a rather stagnating levels. So with a few exceptions, of course, for example, Croatia has seen a steady expansion in the construction sectors that mostly reflects their high GDP growth rates, which is driven by the inflow of EU funds. So those funds were basically financing a lot of the infrastructure spending there. Yeah, but for a lot of other countries, especially those at the top grids of the chart, you can see mostly the stagnation levels, right? So those are countries that are seeing basically a similar level as before the pandemic. So well, of course, a lot of the factors are important here, but I think one of the common trend is that, of course, the interest rates, which are still above their pre-pandemic and pre-energy or inflationary crisis levels, right? But also we have seen a surge in construction input cost. At the same time, the inflation period was actually a huge blow to the purchasing power of the households in the region. So of course this kind of exacerbate a downward pressure on the demand side for the construction, especially residential one. And then taking a bit closer look to the metals sector. So I think this part of the economy is having a much harder actually period. So in the metal sector or the manufacture of basic metals, we are seeing actually a stronger recession for most of the countries. Not all of them are some of them are, let's say, in stagnation, so nothing much better. But yeah, I think and what you can see also is that the sector has seen the biggest actually fall just right after the invasion of Russia on Ukraine in 2022. So that of course triggered a huge increase in the energy crisis. And as we all know, metal sector is the part of the economy that's much more energy intensive. So that's of course so it's no coincidence that basically across the region we have seen a huge fall just right after the energy crisis or the invasion, and at the same time the gradual phase out of the imports of gas from Russia, right? So the sector that's a bit farther into the value chain, so the manufacture of metal products, except for machinery and equipment, is in a slightly better condition than the basic metals production. So it's performing just as a wider. I'm sorry. It's performing just similarly as a wider industry sector, right? So, for example, for a lot of those countries on the left-hand chart, you can see that they kind of resemble the performance of the general industrial production. So, for a lot of those countries, we see a stagnation basically. And the reason for that is that there is actually but much more space to compete in this kind of segment. You can compete a bit more in the quality or the automation of the processes than in the basic metals sector, which is much more reliant on energy costs and wage costs, right? So this is something that Eurozone and Europe in general cannot really be proud of, let's say, or it's hard basically to compete, for example, with China. Yeah, and of course, moreover, the sector can receive supplies outside of Europe, so they also they can actually receive a bit cheaper the inputs to their production process. So, and as I mentioned, the energy crisis was a huge blow to the metal sector. So, right, as you can see on the right-hand chart, the energy prices or the natural gas and then LNG prices has skyrocketed basically in 2022, but even before. And it's gas is still for a lot of people it's this energy source that will or the gas energy is this source of energy that's basically very useful in this transition process, in the energy transition. So of course we are seeing a rise in renewables, but at the same time we need some kind of more not so volatile energy source, and natural gas is it's part of this energy mix that's is being more and more important. But yes, since basically the invasion of Russia on Ukraine and this phase out of the imports that followed, Europe in general actually struggled to find a right imports for a right price. We saw actually rise in imports of liquefied natural gas from USA. So that's that to some extent it offset this phase out from Russia. But the problem is that the liquefied natural gas is, of course, a bit more expensive. So you need to actually liquefy it, right? So at the beginning of the transport, you need to liquefy it, and then at the end, at the gasoport, you need to deliquefy it. And of course, so this will always be slightly more expensive than just directly importing through the gas pipelines. And it's of course undermining the cost competitiveness of Europe in general, and it's undermining the cost competitiveness, and especially from the energy point of view. Well, on the left-hand chart, we can see some steam coal prices. This time for Poland, but I mean this is a very standardized commodity, so we can more or less expect it in the region, in the wider region as well. So the good side is that it's actually in a downward trend, but on the other hand side, we still see that it is much above the pre-pandemic levels. So you can see in 2022, for example, compared to what's currently is in 2025. The PACMI one is actually the one type of coal that is used more in energy production. So it's much more relevant. Of course, in steel production, in steel manufacturing, it's also it's actually coke that's being used, but the prices are correlated as well. And even if the steel plants are using the electrical source of energy, so the electrical arc process, then still, for example, in Poland, a lot of the energy is produced by coal, and it's it's impacting the energy prices. I think I missed one slide. All right. Yeah, then coming to the metal prices, they are actually in a much more downward trend. So one factor that's impacting this, so we can see on the right-hand chart the ferrous metal index price index. One of the factors that's impacting this, that we are actually coming back to more or less pre-pandemic level, is that a lot of this source of production is coming from China, which is steadily increasing their mining output. So that's putting, of course, a downward pressure on the metal especially the iron ore, for which China is the second biggest exporter. When it comes to the non-ferrous metals, the situation is actually much more different. So we are seeing, of course, there are a variety of different applications to each of those prices, but we are generally speaking seeing a downward trend, albeit still much above the pre-pandemic levels. Then coming to the eurozone, or it's of course a substantial source of the demand for both for especially the metal sectors, and the situation, as we all know, is dire, especially in Germany, which is the key trading partner for majority of the Central and Eastern Europe. So they are actually seeing definitely a recession. They're definitely seeing a recession for their industry. Albeit there is some, you can see in early signs of a turning point in the Eurozone industry. That's, for example, you can see, take a look at the 2025, which we see a small upward trend, a turning point for Germany, but also wider for Eurozone. It seems like the interest rates to some extent are starting to take some effect. Of course, we are at the level that's still definitely in a recessionary territory. So it's also hard to expect a continuation of downward trend. But this is also confirmed by the survey data, or like a much more soft source of data. So basically, the PMI is actually reached first time since 3 years. It reached levels above 50 points. So that's basically the survey that's being done among the logistic managers in the manufacturing sector, surveyed about their expectations related to employment, new orders, or the future output, and they are actually getting more optimistic. The same goes actually for the new orders. They are actually, since some time, they are actually positive. The expectations, or the increase in new orders, is actually positive. So it gives us, to some extent, an optimistic view about or the outlook when it comes to the Eurozone. And of course, that's, for example, automotive sector is I think actually one of the biggest sources of demand for steel industry. So that's I would say definitely a good a turning point. Yeah, and so I already mentioned a bit about the monetary easing. So of course, on the right-hand chart, we can see the consumer price index. It's much below, the energy crisis. So we have reached a double-digit numbers right now. Not actually, none of the countries in the region are, in those territory. Actually, for a lot of those countries, we see a territory which is aligned with the central bank targets, right? And because of that, we could afford, or the central bankers could afford, some degree of monetary easing. Actually, you can see on the left-hand charts the policy interest rates by the major central banks, and for all of the countries, we saw some monetary easing. For this year, we actually expect, it's rather pause across the region, with except for a single rate cut in Poland. But when looking, or when listening to the rhetorics, or the speeches by the central bankers, we can see that they are pretty much comfortable with the current level of the interest rates. What it means that they see it as a neutral stance, right? So not neither a restrictive monetary policy stance, but also not any kind of stimulative. Right, and I already mentioned just a tiny bit about China. So it is one of the source of a concern across the world, basically, because for a lot of the time they have seen actually increase in the construction output, which was a huge source for demand for steel, but also other metals like copper. That was, to some extent, it was to benefit of of the other countries, but so far they are struggling domestically, especially. They are struggling in terms of the construction output. They have seen a crisis, or even you could say a pop of the construction bubble some time ago, and it undermined not only the construction output sector, it undermined as well the purchasing power of the Chinese households. And the current situation is that the domestic demand is basically not enough for in the manufacturing sector or industry sector, not enough of a demand for the production. So what we see in China is basically the overcapacity, which, as I mentioned, is a concern. You could see, we already have heard, for example, the governors of the institutions like World Bank or actually Janet Yellen, so the current Treasury Secretary of USA, being definitely concerned about this rising trade surplus of China, of the fact that their production is seeking alternative rather than domestic markets, and this comes at a cost to the manufacturing in Europe, also in the manufacturing USA, because that's of course an increasing competition for European markets. But that's not only the end of the story. Of course, well, you may know or not, but the China is of course actively subsidizing a lot of the sectors. Some of them strategic, some of them less so. So, for example, on the left-hand chart, we can see the subsidies in a variety of form. So, for example, below market borrowings. So basically, just a state giving loans to some of the sectors. You can see some grants or income tax concessions. And as a share of firm revenue, right? So one of the sectors that benefiting a lot is solar photovoltaics, but also a part of the metal sector, right? So aluminium. Aluminium is the second biggest benefactor of the subsidies. We can see also steel being a significant, well, you know, a significant benefactor. But moreover, you know, steel is actually not working at the margins comparable to other sectors. They are a tiny bit more smaller, right? So even like you know, even this level of 1 to 2% of firm revenue is having a significant support or significant, you know, help for the Chinese manufacturers at the cost of you know, at the cost of the, for example, European manufacturers. And at the end, let's talk a bit about the trade wars. So yeah, of course, since April, we have seen the Liberation Day. So the Donald Trump introduced the tariffs that were basically equal to 36% of their imports. So the average effective tariff rate reached 36%. Since then, we have seen some negotiations. Right now, we are settled at 17%. But of course, this is just the average. Some sectors have seen a higher tariffs, and that's definitely the case for metals. On the left-hand chart, we can see the sector exposure in the CEE region to the US demand. So of course, CEE region is not really that much exporting to the US. But they are of course exporting a lot to Germany, which on the other hand is of course the biggest exporter to US. So we can expect that some of this demand shock will be actually transmitted from Germany. That's why this share of value added in US final demand that's being calculated by OECD is actually, you know, giving us some measure of this exposure, because it also takes into the account the third-party countries. And one of the countries that's being the most exposed, especially their manufacturing of basic metals and fabricated metal products, is actually Austria. For Croatia, it's very uneven. So, for example, manufacture of fabricated metals is actually pretty exposed to the US demand. On the other spectrum, we see Lithuania, Bulgaria, and Latvia being the least exposed, but still much more than we could expect looking only at the export values to the US. And well, then, as I mentioned, the average effective tariff rate is around 17%. But actually, the effect has been a bit more subdued. That's mostly because we are the observed tariff rate. So actually, when we just assume the duties collected from the tariffs by the total imports, it's actually around 8%, right? So it's much more. Of course, it's much more higher than what we saw before the trade wars. But it's a bit tiny less than what's just on the paper, you could guess, right? And yeah, just also like looking at the case of metals, it comes the question who's bearing the cost, right? Because of course it could be either like the domestic producers, domestic in US, the importers or rather the foreign manufacturers, right, or the households. And for metals, it's been a bit distributed across the both manufacturers domestically, but also by the exporters from Europe or the CEE region, right? We can see that import prices have fallen to some extent. These actually doesn't include the tariffs itself, but also the producer prices have skyrocketed. These are the domestic actually producers. And this will be all from my side. Now I will give a scene to my colleague. Thank you all.
Thank you very much, Mateusz. So let's focus a bit on construction and metals in Poland. I tried very much to start from some kind of positive, with some kind of positive news, but I struggled, to be honest. So let's put it this way. Our construction assembly production in Poland is now 5 percentage points bigger than beginning of 2021, so middle of pandemic. But this is it, I would say, for at least for now, because we are facing now a rather gloomy period in construction starting from 2024. Starting from 2024, our indexes or the year-on-year changes in construction and assembly production are mostly negative. And it's nothing, let's say, new, because when we look in the history, in the past, we see that in construction sector, we are facing cycles. Yes, so we have downturns, upturns. The main concern from my perspective for now is that this downturn trend of the weak situation in construction lasts relatively long now, because it's already second year, and we can expect that the whole year still will be rather flattish or slightly negative. In the past, it was steeper decrease, but also faster and steeper increase. When we look at the segments of construction output, it's visible that the main sources of construction production are really weak. Yes, so civil engineering is facing decrease in 2025, quite sharp one, above 6% year on year. Also, construction of buildings after already weak 2024 is flat for 2025 with slight decrease. Only specialized construction is growing this year, boosted by some investments. Regarding, let's say, what we can expect in terms of construction development, it's visible that construction work permits now are issued in the lower number than 2024. So it's visible that the activity of construction companies, in their willingness to invest, to start new works, is slightly lower. Last 2 quarters were a bit more optimistic after a very sharp decrease in the course of last quarter of 2024 and beginning of 2025, but still it's below 2024. Regarding completed construction sites, construction investments, we are still at a relatively weak level, low one, much below 2021, 2022, and even 2023. So it's visible that this weak situation in the construction sector in Poland is continuing to last. Also, capacity utilization in construction is a bit lower than in 2024. It's visible that it started to go down in 2025, And now with last values, we see slight increase, but it's still below 2024. What is maybe more positive is that construction is still more resilient than the rest of the industry. It's mainly because construction is more focused on the domestic market. It's not so much, it's not facing so many constraints which are related to whole industry, which is much more export oriented, and it's also influenced by the downturn in economy of European Union. Going to the liquidity, this downturn and the decrease of outputs in construction is leading to the liquidity shortages. And it's quite clear it's every time the same. What is concerning now is the speed of those changes. When we analyze insolvencies in construction in Poland, we see that year on year in the first half of 2025, we have 30% growth of insolvencies. And when we look at the total number of insolvencies in Poland, 17% of all companies which went insolvent come from construction. It's the biggest source of insolvent companies among all the sectors. What is also important, we see that the trend of liquidity shortages and overdues in payments in construction is growing. When we look on the right-hand side on the lower graph and look at the dotted line, it's visible that the trend, overall trend, month by month, quarter by quarter, and year by year is negative. I mean, in that sense that the value of reported overdues in construction is growing. After a relatively calm period of pandemic, now we have constant growth of overdues, which is also visible when we compare value of overdues to exposure, which we cover also in Coface in construction sector. Well, if we look for the positive signs, there are two main things which can impact our outlook on the next quarters, next years. First one is what already Mateusz mentioned, this easing of monetary policy by the National Bank in Poland. We faced several decreases of interest rates in Poland. Now it's 4.75, the base rate, which is allowing consumers to look for the new investments and simply to buy more flats, more apartments, and so on. And it's also visible that the new mortgage loans are increasing. So if we compare second quarter of 2025 to second quarter of 2024, it's already increase of 25%. When we compare quarter to quarter, it's visible that in the second quarter of 2025, we have already 30% increase in value of new mortgage loans. So those lower interest rates are triggering the bigger demand in loans, and it also means that purchasing power is increasing. The second part of the positive story, let's say, is that we can still expect inflow of European funds to Poland. To be honest, we were a bit even more optimistic for 2025, and we were forecasting huge increase of this value pumped into the economy of Poland in 2025. It's visible that we have some issues with the utilization of those funds, and this increase of funds can be a bit postponed even to 2026. But still, we have this recovery and resilience fund, which values to 60 billion euro in loans and subsidies, and it will be very much focused or construction can benefit from that because it's very much focused on energy mix transformation, on renewable energy, energy saving technology. So it's very much related to the construction investments. And there are also some investments in pipe which we have to do in Poland in transportation system, energy infrastructure, and so on. It's a bit postponed and it's maybe long-term perspective, but still it will influence the situation in construction. Regarding metal sector, especially steel sector, I would focus mainly on the table, which you see below the graph. And it's visible that the real consumption of steel in European Union is decreasing. 2024, minus 4.4. 2025, we forecast together with Eurofer, minus 2.3%. Together with this, let's say, rebound in industrial situation and the PMIs in European Union, we have a bit more positive outlook for 2026. But it's visible that the steel sector is suffering very much, and it's already second year in the row. So situation in this sector is also very, very tough. Why it is like this? If we have the tough situation in construction, it's immediately passed to the steel sector because construction is the buyer of 37% of total steel consumption in European Union. So it's absolutely visible that construction situation has immediate impact on the demand for steel. Also, situation in mechanical engineering or automotive, we all know it was not very favorable in last period of time, in last 2 years, and also this year we do not expect any significant changes, although 2026 should be already better. What are the main constraints? We have overcapacity of production in Europe, and it's also visible that due to many issues, costs, and so on, production in Europe, production of steel in Europe is decreasing. Even this year, ArcelorMittal stopped production of one of its furnaces in Dąbrowa Górnicza, and it means overall decrease of overall capacity of Polish steel production by 22%. On the other hand, we have a relatively high import of steel products from Ukraine, and in 2025 it's visible that it increased very much. And what is important, Poland is the country which is receiving most of this import. When we take into account European Union countries, it's half of this import is consumed by Poland. And production is very much limited by energy costs, CSR requirements, and generally what I already mentioned, the low demand. It's simply transferring to the further decrease of price of basic steel products. And you can see that year on year, August to August 2024, those basic steel products prices decreased between 7 and 9%, and still they are very low, limiting the improvement of the financial situation of steel producers and distributors. To summarize, the construction sector in Poland for now is facing very hard time, and it's very strong downturn in outputs, and liquidity is very much under pressure, which is very much visible in the insolvencies, in the increased value of overdues. We have some light in the tunnel, which if we treat as such, lower interest rates, inflow of European funds. But it will take time, and the increase of demand and improvement of the situation both in construction and steel sector can be seen only in 2026. Thank you very much. So I pass now the mic to Bogdan.
Thank you, Marcin. And thank you all for joining us in today's webinar dedicated to constructions and metals. So first, a bit of context regarding Romania macroeconomic map. Romania is not doing very well as we speak, in the sense that, well, the business traction measured by GDP growth is declining, very close to 0.3% for the first half of this year. And it is highly important to highlight two relevant factors. First, the fiscal deficit, which is the highest, the largest one in entire Europe, almost 9% last year, recently renegotiated with the European Commission these days at 8.4% for this year, so unsustainably high. And the second factor, the cost of money, so the interest policy rate, which in our country, in Romania, it is 6.5% as we speak. Why are these two factors so important for shaping, especially the constructions and thereafter in metals? They are important because fiscal deficit will shape first the payment behavior of the Romanian state. It is trying, to, in a kind of artificially masking this pressure by deferring payments. And this spells disaster in the cash flow of construction companies. And the second factor is the fact that the Romanian government is forced right now, in order to defend the investment grade rating, sovereign grade rating, to cut back fiscal deficit by cutting back investments, so cutting back especially infrastructure works. Interest policy rates do have an effect on constructions. Why? Because first, you do expect that the corporate interest rates applying to corporate loans are equally high, at least equally high, and this is, of course, a headwind for developers. And the second effect is felt in housing retail loans. So the higher these housing interest loans, of course, there is a disincentive to attract new loans. So coming to constructions, well, it seems that I accelerated a bit the pace of the slides. So constructions in Romania, well, they are doing, the sector is doing better, far better than the economy itself. I mean, this year, 12%, so double-digit increase for the first 7 months insofar. And what is also very relevant for you is to see that the three major subsegments, residential, industrial and logistic, and infrastructure, are all three in positive territory. The prima donna, the VIP of this growth, the engine of growth being infrastructure. You see there 16.3% up for the first 7 months of the year. However, as they say, the devil is in the detail. Yes, the business traction is there in infrastructure, no surprise, because, well, we have right now in Romania the largest historical budget granted to the domestic road administration company. Yeah, you see it in red, yeah, striking up. However, the challenges for the Romanian construction companies working for the infrastructure projects is pretty much related to cash flow management. Once again, I'm highlighting the fact that Romania is forced to manage this very high, unsustainable fiscal deficit. And we see over the past year that the Romanian state, the Romanian authorities involved in infrastructure works are deferring payments. So the monetization of these works is slow. And you can see the construction segment in Romania is a kind of company with nice looking P&L, yeah, so good top line, decent margins, but very lousy, very dangerous, very challenged cash flow from operations. And you know what they say, turnover is vanity, profit is sanity, but at the end of the day, cash is king. So this is the problem for our domestic construction companies. There is no problem for pipeline, no problem to generate additional business. It is the problem of monetizing, of turning this business potential into cash. And we do expect for, well, 2025, 2026, infrastructure to remain through the major infrastructure works projects, well, to remain on the positive side. I mean, for this year, we do expect roughly 150, 160 kilometers of highways and express roads to be completed. This is very close to a historical peak we had last year, roughly 200 kilometers completed last year. So it is most likely that next year in 2026, after 30 years of dreaming, yeah, our dreams will become reality. I mean, linking Moldova to Constanța being the largest Romanian harbor, and also in the next 3 years to link Constanța via Carpathians, via the mountains, via Sibiu, with the two western key gateways in Romania, Arad and Oradea. However, there are two factors to consider for the midterm and long term. The first is, okay, what is next? I mean, once these infrastructure works are completed, what is on the table? And my personal opinion is that once these infrastructure works will be completed, well, there is a huge opportunity for industrial and logistic to follow. I mean, we have seen it in Western Europe, we have seen it in Poland, we have seen it in Hungary, we have seen it in Austria. Once these ring roads, once these highways will be completed, my bet is that industrial and logistic will become the VIP of construction business traction. And the second more fundamental question is about EU funds, EU Resilience Fund, which is going to be phased out starting 2027. What is next? I mean, how we can fund the next generation of infrastructure and non-infrastructure works. This is a fundamental question Romania needs to answer. Of course, when talking about well, constructions, you need to speak about residential too. Well, the short-term prospects in Romania are certainly bearish. They are bearish for two reasons. The first reason is related to cost of money, to interest rates. Housing interest rates in Romania are currently the third largest cost all across Europe. So this, of course, is a problem for the potential housing buyers. It hinders access to housing loans. It is that simple. And the second problem, a more recent one, is the recent hike in VAT. I mean, starting August, VAT has been, well, increased in Romania. And the impact for the residential units is very, very huge. I mean, from 5 to almost 21%. So a huge, huge, huge burden. Long term, however, the prospects, in my opinion, are bullish, and they are bullish for the residential segment. Why? You see on the left, on the right hand graph, the affordability index. In other words, how many average annual wages it takes for a Romanian to buy an average 55 square meter apartment. It takes in Bucharest, for example, less than 9 years, but in Prague, it takes 15 years. So you see, there is life, there is potential in this demand. And that is why I do not think that in Bucharest, for example, we have a residential real estate bubble. So this is actually a seed, yeah, a potential for future growth. And you can see it also in the evolution of the building permits. Yes, over the past 2 years, you see it on the left, building permits, residential building permits headed south due to interest rates, due to political uncertainty. Last year, especially in Romania, we had a turmoil in political arena. But, the stabilization signs are there. This year, year to date, 7 months, plus 4.4%. And also in terms of intentions to purchase, build a home, again, the trend mid-term, long-term is positive. So bearish short-term perspectives for residential, but looking forward to the future, mid-term and long-term, I'm totally confident that the seeds for growth are there. Last but not least, metals. Yeah, and I will focus only on the steel industry, which in Romania is, well, a deja vu picture of what we see in the European context. Mateusz very detailed, has presented a very detailed map of, the problems, the challenges this industry is facing in Europe, and also you saw March in Poland. Romania is sharing the same fate. I mean, these cumulative factors of overcapacity, weak demand, cheaper imports, elevated energy cost is shutting down steel mills in Romania. I mean, look at ArcelorMittal Hunedoara starting September 5th this year, suspending operations. Liberty Galați, the largest Romanian steel mill, in August it launched this pre-insolvency debt restructuring process. So the production segment is hurting for certain, and the distribution also. Also because of stricter and more aggressive fiscal environment. Starting last year, we have a very nasty 1% tax on turnover, which for distribution in steel, it's absolutely stupid. It's absolutely aggressive. It takes away cash flow from companies. It takes away bottom line margins. Are there potential tailwinds? For certain they are. And I think that, in the next years, we will see a major switch of attention and investment funds in railway infrastructure. You cannot make decarbonization of European transports without railway. And Brussels is going to shift major funds into these. And we also, Romania, could benefit from these. And also the ending of Ukraine conflict. Let's hope for the best, albeit you see these days it becoming more and more elusive and least likely. So yeah, these are the colors of constructions and steel industry in my native country, Romania. Thank you all for your attention, and looking forward for the upcoming questions session.
Thank you. We still have a few minutes. I'm sorry, I need to mute you. So we still have a few minutes left. I want to remind you how you can ask questions. So on the right corner of your screen, you find a question mark symbol, and then you can type in your questions. And I will address them to our speakers now. And I can see that we already have the first question, and I will address it to Mateusz. Oh. Okay, I don't know if I understand the question. The question is related to construction in Germany. Do you have a
outlook, right?
A comment on this?
Sure. Yes, definitely. I think it's definitely worth it to mention, and I actually didn't address it good enough due to some time constraints. But yes, so there is actually a lot of interesting things going on there. So the construction sector in Germany is currently in an absolutely dire situation. So the building permits are at the same level actually as in 2010 or 2011, but there are some signs of rebound, right? So even the said permits, building permits for both residential and non-residential are actually rebounding from the very bottoms. So to some degree, that's due to well, much more accessible cost of financing. So we saw some monetary easing by the ECB. So and that's of course some source of demand, right? So a much more accessible mortgage is of course a better source of demand. But there are also some much more important things going on in Germany. So the change in the fiscal rules and the increase in the fiscal deficit by the MERS coalition, it basically marked a watershed in the approach of the Germany to their economic policy. So they are willing to actually spend pretty big time, I could say, and this fiscal spending will mostly go to the infrastructure spending. So, for example, as some of you may know, the Deutsche Bahn or the German trains are actually considered by many to be underinvested. And you know, the current coalition actually realized that, and they are willing to change that. So a lot of the fiscal spending will go to, for example, the railway. So probably also to some degree civil engineering, less so for the residential types of constructions. And the fiscal spending is actually going to be very much evenly spread through the next 10 years. So according to our calculations, it will reach around 1.5% of GDP of additional spending. That's a significant amount, but we won't see like a bonanza of construction spending. But the next year should be, I would say, should be better.
Thank you, Mateusz. Another question to you. Can you tell us about the impact of increasing expenses in the defense industry on metal sector? Do you have a forecast here?
Yeah, so actually also speaking about this fiscal spending, which will also be, spent on the military. So Europe in general actually realized that they can no longer rely on the US as a sort of military umbrella, right? And they are willing to spend, of course, more, and this, especially so in Germany. So of course that's a huge source of demand. The military, of course, for the metal sector and especially for the steel. So of course, any kind of tanks, any kind of the howitzers are actually, they require some sort of source of steel, and it also seems like especially the current policymakers are kind of realizing that they kind of require this spending to have to be not so much import intensive. That was something that we were concerned about. So that, for example, in Poland, that this military spending, but also in Germany, will actually go to the foreign producers. But when looking at the procurements right now, it seems like this local content, or the content that's being sourced by the local producers, is actually, it's actually pretty important for the policymakers. So I'm pretty positive that this will have a huge source of, this will, provide some turning point to the sector.
Thank you, Mateusz. We are now at the end of the webinar, but there are still some questions which we will, of course, answer as a follow-up individually. We will contact you. And yes, as a reminder, we will share this slide deck with you and also the recording of the session. You will receive an email in the upcoming days. And I thank you all for joining and for your interest in our webinar. We hope that you found it insightful and you could take away some useful perspectives on the construction and metals industry. And we hope to welcome you in one of our next webinars. Gentlemen, thank you for sharing your insights.
Thank you all.
Thank you.
Thank you all. Thank you all.